Whew! How about that GameStop, guys? Numerous people in the comments section have asked me for more of my opinion on the events of the last week, and I wanted to wait until the weekend to gather more information. But the last week was unprecedented. The last week will be extremely consequential going forward for all investors. The reason why is because Wall Street Bets essentially formed their own crowdsourced hedge fund, and they've done something that no other hedge fund has done. They exploited a glitch in the matrix, and this glitch in the matrix was always there. What they accomplished this week was always possible, but it had never been done. And let me explain it. If you think the stock market is going up, you have three tools available to you. You can buy the stock, which is what most ordinary retail investors do. You can also buy a call option, which gives you the right to buy the stock from somebody else if the price goes up. You can also sell a put option, but that's mostly just to collect the premium for the contract. You want the contract to expire out of the money. Now, if you're a contrarian and you think the stock will go down, once again, three tools. You can short sell the stock, where you borrow it from your broker, you sell it on the New York Stock Exchange, you wait for the price to go down, you buy it back at a cheaper price, return it to your broker, keep the difference, that's your profits. You can also sell call options, and this is what hedge funds have done to get themselves in trouble. Now, if you own 100 shares of stock, you can sell a covered call, which is fine. You'll just lose your stock if you were wrong about what the price will be in the future. However, they were selling call options without actually holding the stock. And the reason why is because they were manipulating the stock price. They were selling call options when the price looked reasonable to ordinary investors. Ordinary investors were looking at the price saying, well, it could go up. GameStop's not doing that terrible. We think this company is undervalued. Now, these hedge funds were then short selling the stock to manipulate the price. They were deliberately driving it down so these contracts would all expire worthless out of the money. They didn't want to have to cover their calls by buying 100 shares on the New York Stock Exchange and then selling them at a loss to these other people. And this is what is breaking the stock market right now, where so many of these call contracts have been written that there isn't enough GameStop shares in existence to cover all of these calls. The third tool I didn't mention is they would buy a put contract, but once again, they're hoping that the contract will expire worthless out of the money and they'll just collect the premium. They're going to lose the premiums if they were buying any put contracts because the price of GameStop has gone way up. Now, what has happened in the last week is the most epic short squeeze of all time. A short squeeze of an entire hedge fund, multi-billion-dollar. And this has never occurred before because there's always been a gentleman's agreement on Wall Street between these companies that this event would never occur. So when these hedge funds take contrarian positions and they start manipulating the price and buying all these contracts, they publish their books. They make it public to the other companies what they're doing because they don't want another hedge fund to jump in and do exactly what Wall Street Bets did. So when you see a company that's failing or doing poorly, you basically lay claim to the carcass. You say, this company, GameStop, is mine. I am going to manipulate it. I am going to defraud all the retail investors trying to jump in because they think this company is undervalued. So the other hedge funds stay away. This event doesn't occur. However, Wall Street Bets doesn't play by the rules of Wall Street because they're not on Wall Street. So they saw what was happening, and they decided to trigger the events of the last week. And this is very bad if you work on Wall Street. The people who work on Wall Street made sure this event never occurred because they don't want scrutiny. They wear very fancy suits, they go to elite universities, they use very fancy language, and they do this because they're exclusionary. They don't want you to feel like you belong in the markets. They don't want you to understand how it is they actually make their money. And the reason why is because it's kind of a casino. You know, they're deliberately manipulating the market. To participate in a hedge fund, you have to be a millionaire. It's millionaires banding together to have billions of dollars in assets so that they can manipulate the market cap of small cap funds, you know, market caps of hundreds or potentially up to $1 billion. So what happened is GameStop was supposed to fail. And it didn't. And I'm sure these individuals on Wall Street are very upset about this because they broke the rules, the unspoken rules of Wall Street. And a lot of these people who work on Wall Street are sociopaths. They don't care about people. They don't care about individuals. It's only about making money. If you've never seen the movie American Psycho, it might be more relevant now than ever. It's a difficult film to watch, but it's Christian Bale. It came out in 2000, and he plays one of these executives working at Salomon Brothers, which went bankrupt like in 1990. Bonus points if you know who this guy is. But the two hedge funds that have gotten caught up in GameStop's issue is Melvin Capital and Citron Research. And people who work for these hedge funds or private equity firms, they're not innovators. They don't have any good ideas. They don't create jobs. They're parasites on the system. They found a way to exploit the market to make money for themselves, and they don't care who they hurt when they do it as long as they make money. And they're just vultures. Between private equity firms and hedge funds, they've destroyed a lot of well-known companies that I've enjoyed my entire life. I'm in my mid-30s. I went to Sears and Toys R Us, and they tried to do to GameStop what they've already successfully have been doing for decades. And let me explain to you the process. So GameStop's share price on July 7th was $4 per share. And there's only about 70 million shares in existence. So $4 times 70 million equals 280 million. That's their market cap. Potentially what was planned by hedge funds and private equity firms was a leveraged buyout. And the reason why these private equity companies do this is it's a controlled demolition of the company. They're trying to bring it down. And what you do, let's just talk about Sears as an example. The private equity company comes in and they have a controlling interest in the company. They either take it private or they control so many shares that they get to appoint the board of directors. And they put somebody in charge of the company who deliberately runs the company into the ground. What they do is they don't innovate, they don't adapt, they don't try to stay profitable, but they take on massive debts. And who do they take that debt from? They borrow from the private equity company that just bought them out. So this company owns Sears or whoever, and then they're borrowing more money from them. Why would they do this? It doesn't make any sense, right? Well, the reason why is because they're trying to bankrupt the company. And when the company is bankrupted, either they're sold again or they're liquidated. And if they're liquidated, everything that the company has the rights to or owns has to be sold off. All the employees are fired. And the debt holders, when the company is liquidated, are paid first. So the company goes bankrupt, the debt holders are paid. Who do they pay? They pay the private equity firm. And the company going bankrupt has no impact on the books of the private equity funds that bought a controlling interest in them. And the hedge funds who were shorting it are happy because the stock price went to zero. That's what they wanted. If you shorted 1 million shares of GameStop at $4, and the share price goes to zero because they went bankrupt, you just made $4 million. You never have to buy back the shares. You never have to return them. So who are the losers in that scenario? And the losers are retail investors. It's employees of the company. It's people who are paid in company stock. It's people who have pensions with that company that aren't going to be able to fulfill them. So the hedge funds and the private equity firms don't care about the communities or the people that are completely devastated when a company that could have been saved, when a company that could have remained profitable or turned around is just completely demolished. And GameStop was supposed to be next. GameStop was probably going to have a leveraged buyout. It was going to go private or somebody was going to get a controlling interest once the shares had been depressed to under $2 potentially. But that's not what happened. What happened is because this stock was so shorted, Redditors started buying it up. One, it did look undervalued according to its book value. So what happens when there's only 70 million shares in existence? What happens when 7 million people try and buy 10 shares each? They basically just gained a controlling interest in the company. And if they refuse to sell their shares, When these contracts expire and the hedge funds have to buy on the open market to sell at a loss to whoever bought those call contracts, once again, it's happening. It's happening every week as these contracts expire, that they're losing tens, hundreds, potentially billions of dollars. And this is the biggest short squeeze in history. You see this on daily or weekly charts potentially. You know, the stock price will shoot up 10, 20, 30, 50% as smaller dollar investors, day traders get squeezed out, but never on a scale of 3,000, 4,000% as GameStop's price went from $4 to almost $400 at one point. So what is the fallout of all this? And the fallout is that Wall Street Bets has exposed this flaw in the system. And a lot of people are calling for regulation. Now, is that regulation to stop the hedge funds and the private equity firms from manipulating the markets and destroying American institutions, you know, companies like Sears? Or is the regulation going to be, hey, you're not allowed to go on social media and then collaborate, buy stocks? Right now, you know, we're getting pushback from the industry. But my argument is you can't regulate people identifying inefficiencies in the market. The share price of GameStop right now doesn't matter because it's the option contracts that's driving the price. Yes, when you buy a stock, you should be buying it based on the equity of the company. What is the company worth or going to be worth in the future? But why do you buy options contracts? The only thing that matters with an options contract is the price. It's a bet. You don't buy option contracts because of the equity in the company. You buy it because of the price. And if people want to pile into the stock, they're also buying up the contracts too. If people want to take the contrarian position to identify that these hedge funds were wrong, GameStop wasn't doing that terrible. It's not doing great, but it wasn't $4 a share. So the stock was overshorted, and these hedge funds got caught, and they're going to pay. But Wall Street is pushing back. The insiders are pushing back. The NASDAQ CEO Friedman says the exchange will halt trading on any stock if they link unusual activity to social media chatter, which is a joke because market price manipulation occurs all the time. On CNBC, Bill Ackman, a billionaire, went on CNBC numerous times to say all the hotels are going to go bankrupt. Hotel stock prices are going to go to zero because of the pandemic. Everybody sell your hotel stocks. He then, prior to making all these public announcements, bet against the hotels, saying they would all crash. They then crashed. He made a huge profit. He then took his profit to invest in the hotel stocks while they were depreciated and has made a fortune since then. So billionaires do this all the time using the original social media, print, television. And for any elected representatives who come out saying we need regulation of Wall Street bets, well, the Justice Department is closing their insider trading investigation into senators and congresspeople who received briefings on the pandemic in February, immediately went and sold all their stocks, waited for the stock market to crash, they then bought back in at the lows for a huge profit. The joke is Wall Street wants to ban outsider trading. Insider trading should be illegal. People on Wall Street Bets don't have insider information. They're not getting congressional briefs to know what's going to happen in the market in the near future. They're taking the information that is publicly available to them and making the best financial decision for themselves. And a casualty of the GameStop fiasco might be Robinhood itself. You look at this headline, how Robinhood went from hero to villain in 48 hours on Thursday when they stopped people from buying stocks like AMC and GameStop. We'll never know what really happened. They did a terrible job with messaging the day of, but the conspiracy is that Citadel Securities, which handles Robinhood's order flow, is also an investor in Melvin Capital, which was getting destroyed by this short squeeze. So potentially Citadel Securities got involved, but it doesn't matter. It doesn't matter what happens because they're going to get sued, and they should, because they manipulated the market. By allowing people to sell on their brokerage accounts but not being able to buy, the stock price immediately started falling. It could only go one direction at that point. But it's irrelevant because Robinhood bought the hedge funds time. This weekend, I guarantee you, nobody at these hedge funds are getting sleep because they're trying to figure out how to get out of this situation. They have clients who belong to their hedge fund, who are millionaires, who are going to be thoroughly upset that they lost all of their money in this GameStop squeeze. Now, I have not been participating in the purchasing of any of these stocks because I just don't see how it ends well. You know, it's funny in the short term, but for all of these companies that have been struggling or their share price has been depressed or aggressively shorted, if retail investors want to pile into these stocks to mess with hedge funds, that's fun and entertaining, but you only make money when you sell your stock, and ideally you want to sell it for higher than what you paid for it. But what these companies can do if their share price starts recovering is issue new stock, do a secondary public offering. And this helps the hedge funds, this helps the shorters. It helps the company too. You know, AMC wants to, their management is trying to save the company. They want to remain solvent until the pandemic is over. And retail investors piling into their stock is actually helping them. Same thing with American Airlines. American Airlines doesn't want to go bankrupt. They don't want to have to fire employees or liquidate assets. So with retail investors jumping into these stocks, the companies are issuing new shares, and it's driving down their price. But they're making money that they can use to survive until the pandemic is over. But in the short term, this helps the hedge funds. It keeps the price down so they're not losing as much on their contracts. Now, is GameStop going to do this? Is GameStop going to issue new stock to pay off their debts? And I honestly don't know what GameStop is planning. Will they issue new company stock? If they do, that will drive the price down and hurt the retail investors piling in to help them. However, that's how they raise money. You know, they've taken on a tremendous amount of debt. If they want to raise capital to retool their business to remain solvent or pay down debt, now is an excellent time to take advantage of their inflated share price and issue new stock. But issuing new stock will hurt the Wall Street bets crowd in the short term. So I don't feel comfortable participating in any of these shenanigans. I don't recommend you do as well. If you are smart enough to buy GameStop stock under $40, you know, closer to $20, so if you jumped in this basically any time before January 13th, and you want to hold because you think this is hilarious, then keep those diamond hands, hold. If the stock price fluctuates between $400 and $300, your profits are already massive. You're up huge. If you bought down here, I'm telling you to hold because it's hilarious and it's not that much money probably. You know, it'd be nice if you could sell at 400, but if it goes down to 200 or 100, you're still 5xing your money. But should you be buying at 300 or 400? No, I can't recommend you guys do that. Will the share price shoot up to 1,000, 2,000, 3,000? I don't know. It could, or GameStop could issue new stock and it just craters. Okay guys, those are my thoughts. I do want to conclude this video by saying I am not a financial advisor. I do not work on Wall Street. This YouTube channel is just me, a complete amateur, giving my opinion. I could be wrong. I don't mean to take offense to anybody or slander any company or industry. Free speech. I'm just saying what I'm saying. Don't take me serious. This video is for entertainment purposes only. But give me a like if you enjoyed it, and subscribe if you haven't already subscribed to my channel. I talk about finance and investing topics. Leave me a comment down below if you want to help me out with the algorithm. And until the next video, take care.